Today I'm going to share with you why you should invest out of state. This is exactly how I was able to start investing in real estate with just an average income. I started almost 5 years ago when I bought my first out-of-state rental property with $18,000 I saved up to cover the down payment and the closing costs, and I was able to more than triple that investment in just 15 months. This is the power of investing out of state, and had I just tried to save up my money to invest in my own backyard of Los Angeles, I might still be trying to save up to this date. What's up, guys? It's James Allen, the Out-of-State Investor. Today I want to share with you 4 reasons why you should consider investing out of state. But before I get started with that, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. Out-of-state investing has been huge for my family and I, and honestly, I didn't even realize how possible it was. I mean, how could you possibly build an entire rental portfolio thousands of miles away? The reality is we've made huge progress when it comes to technology, and because of that, it's easier now than ever before to invest out of state. So with that said, here's 4 reasons why you should consider investing out of state. The first reason is it takes less money to get started. Now, of course, this is going to depend on where you live. If you already live in a very affordable area like, let's say, Detroit, then maybe this doesn't apply to you. But if you live in places like Los Angeles, like New York, even places like Denver or Seattle, then investing out of state could be a great way to go. Now, I grew up in Los Angeles for most of my life until about 2 years ago, and if I was going to buy a rental property over there today, I'd be looking at a median price of about $815,000. Now, anytime you're looking to buy an investment property, generally lenders are going to expect you to put 20% down, which means if you're looking at a median priced house, that's $163,000 just for the down payment. But even if you look at cheaper houses below the median price in Los Angeles, let's say a $500,000 house, you're still looking at a $100,000 down payment, not to mention closing costs, inspection fees, reserves you're gonna need. So when you factor in all those costs, you're looking at being all in at about $130,000, and that's not even for an average piece of LA real estate. I mean, at $500,000, you're way below the median price. Now, if you're making hundreds of thousands of dollars a year, maybe that's not that unrealistic for you to save up that kind of money. But for my wife and I, we were not making that kind of money. In fact, we were making an average size income for our household. And so because of that, the idea of saving $130,000 seemed like that would take us forever to do that. So for that reason, when I got started looking into real estate investing, I started looking into areas further away from me, areas like Palmdale, California, where I could buy a house for under $300,000. But even in that situation, I'm still looking at around a $60,000 down payment, not to mention closing costs and everything else that goes into it. So I started to look into other things like out-of-state investing. Now, this was back in 2017, and when I started looking in some of these areas out of state, my mind was blown at the prices I could pay for these houses. I mean, I bought my first investment property for $63,000. So the down payment on that was only $12,600, and even with closing costs included, my total out-of-pocket expenses was about 18 grand. So because of this, it ended up speeding up my journey drastically, and I was able to get into real estate investing way sooner than if I would have tried to save my way up to do it in my own backyard. So for that reason, out-of-state investing made way more sense for me. Now, if you want to have a better idea of exactly how much money you need to start investing in real estate, I highly recommend checking out a video I recently did on that, link above and below in the description. Now, the second reason to invest out of state is you can get better cash flow. Now, again, this is assuming you don't already live in these destinations, but if you're living in expensive areas like San Francisco, Denver, Seattle, then you are going to get much better cash flow investing in some of the popular out-of-state destinations. The main reason for this is what's known as the rent to price ratio. It's basically how much rent you're getting based on the price of the house. For instance, if I bought a starter home in Pasadena, I might be able to rent it out for $4,000 a month, but it probably cost me about $1 million to buy it in the first place. So if you take the $4,000 a month and divide it against the $1 million price point, you're looking at a 0.4% rent to price ratio. Whereas with out-of-state investing, it's not uncommon at all to find a 1% rent to price ratio. So basically for a $100,000 house, you can rent it out for $1,000. Have 10 of those for $1 million, and now you're getting $10,000 a month rent instead of $4,000 a month. But the benefits aren't just simply making more money on a monthly basis. It also helps you scale your portfolio for the long term. You see, when you're choosing a market to invest in, every market has something different to offer. But in general, it really comes down to 3 different different things. You're either looking at appreciation markets, you're looking at cash flow markets, or markets that offer you a little bit of both. So with that Pasadena house I was talking about, that's going to be more of an appreciation play. You're probably going to look at negative cash flow on a month-to-month basis, but the appreciation is going to be really good. But with that said, the reality is, as an investor, you can only handle so much negative cash flow before you can't buy any more properties. It's obviously going to depend on how much you earn. Obviously, the bigger your income, the more negative cash flow you can manage to take on. But if you're earning an average income, you may not have much room in your budget to afford negative cash flow properties. You may only be able to afford one of them, and then you may not qualify for any more properties after that. This is exactly why I like to target markets that give me that combination of cash flow and appreciation. Obviously, appreciation is great for building tremendous wealth, but at the same time, cash flow is going to help me continue to scale my portfolio over the long run. The reason for this is that rather than losing money every time I'm buying a property, I'm actually increasing my income so that every time I buy a property, it's making it easier and easier to save up more money, and it's almost like the snowball effect. And on top of that, when you're buying cash flow properties, it makes it easier for lenders to continue to qualify you for mortgages to continue buying rental properties. And finally, by investing in areas that produce cash flow, you don't have to worry as much about what the market does. Even if it goes and makes a downturn, you can still make money every single month with your monthly cash flow. Now, the third reason to invest out of state is you have the ability to control your returns. Now, this kind of goes hand in hand with what I was talking about before. You see, rather than having to deal with whatever your market offers you, you can find the market that best suits what you want. So if you want to buy properties that are great with cash flow, you can find markets that are tailor-made for cash flow. If you want to invest in a market that has better margins, there are some markets that have better margins than other markets. You can go find those markets and invest there. The point is that you have the ability to choose the market that best suits what you're looking for rather than having to deal with whatever the market you live in is offering you. Finally, the fourth reason you should invest out of state is you can target landlord-friendly states. Now, one of the easiest ways to lose your investment is when you have the law working against it. Now, I've heard countless stories of people who invest in tenant-friendly states, and it takes them months and months and months to evict a tenant that's not even paying rent. They end up losing thousands of dollars between all the months they lose rent, between the attorney fees, and it's just a big expensive mess. So with that said, when you invest out of state, you have the ability to invest in a landlord-friendly state where the law is on your side and the law will protect your investment. Where if tenants aren't paying their rent, you can evict them in 2 weeks and move on to a tenant that is going to pay you rent. Again, you may already be living in one of these states, and if that's the case, then maybe out-of-state investing doesn't make sense for you. But for those of you in unaffordable areas, in appreciation-based markets where you can't find cash flow, and especially where the law is not on your side as a landlord, investing out of state is a great alternative to investing in your own backyard. So with that said, I hope you guys enjoyed today's video. Hopefully you found some stuff helpful. Hopefully you learned something. And if you gained some value, do me a favor, support the channel and smash that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know in the comments below, where are you investing right now? Are you investing out of state? Are you investing in your own backyard? Finally, follow me on TikTok and Instagram at The Out of State Investor. Thanks again for watching, and I'll see you on the next one.